Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action. All right, today we've got Reed Goossens with us. Reed, thanks so much for coming on the show. Before we get started, do you want to just tell us a little bit about yourself and maybe how you got into real estate?
Sure, yeah, thanks for having me back, guys. Weird accent, originally from Australia, moved out here chasing a girl, moved here in 2012. My background's in structural engineering. I moved to New York City without a job. I door knocked until I got a job. Then quickly realized how the US is made up of essentially like the states are like individual countries, compared to say versus Australia. Like there's secondary markets and tertiary markets, and you can buy a property for $30,000. Like you wouldn't get that in Australia. So mind blown when I first got here, and you fast forward to where we are today. I've founded two different syndication companies. We've done nearly $1 billion in acquisitions across the last 12 years. We've cycled 7 deals. We have 31 transactions to date, and we do asset management in-house, construction management in-house. We're across 7 different MSAs at this point, and you're looking to continue to grow into the future.
That's quite a track record. We are excited to have you on. So I think that we were going to jump into just kind of talking about the current market and maybe, a look at how you would view an opportunity, when it feels a little bit uncertain. But, I would say, we're about 4 years into a recession.
Yep.
And, the last recession, I think, was 4 or 5 years. So,
yep, no, I completely, and I think we have to. So let's break it into its pieces, maybe about what we're doing. So when I first got started back in 2012-ish, we were buying with fundamentals, agency debt, positive leverage day one, and what has happened since then, and we're probably all, let's call it the quiet thing out loud, like we are beneficiaries of the Jobs Act changing in 2012, right? Where retail investing became a lot easier to access into private markets, private deals, and we've all benefited from that. I have, you guys have, and it's been a good thing, right? But there's also been a lot of capital into the space, and that changed the way it became it's very crowded, and we peaked in 2022, right? When interest rates started to go to the moon. But today we're fundamentally we're going back to those fundamentals. Positive leverage, day one.
You said it twice. I'm sure that there's plenty of people who don't understand what positive leverage is.
Let's break it down. So the delta between, or the difference between the going in cap rate and what you lock interest rates at. So say you're buying at a 6 cap and you're getting interest rates at a 5 cap. That's positive leverage. Couple of years back, when rents were going skyrocketing, you may have gone negative leverage where you're going in cap rates of 5, but your interest rates at 6, and you're betting on the come that you're going to renovate those units and pop your head above water, right? And that's where some people got into a lot of trouble, and there's blood in the streets today, which we'll come back to and talk about in a minute. But back to the fundamentals of like what is multifamily investing, and we've seen in the last 4 years, depending on what markets you're invested in, there's been a massive reset. And we'll probably see the 4 years we just come through, we'll probably coin as the historical reset of our generation. And now is a really good time to be buying. However, there's a lot of capital still sitting on the sidelines, and attracting capital in today's market is very difficult. But it is a good time to be buying. And I know you guys are active in the Northeast, and you're seeing discounts. Northwest.
Yep. And different Portland, you got.
But you're seeing the opportunity like we're seeing, and I think that's the beauty of real estate, is that it's not like the stock market that's jumping every 30 seconds, right? You can kind of see when you hit the bottom or when you start to get to peaks, and we'll look back at decisions made 2021, 2022 and say, I wish I'd had my time over again. I wish I'd do it differently, right? Like people would look at today and say, in 3 or 4 years' time, I wish I bought in 2026 or 2025, right? So, I think I think we've already hit the bottom. I think we're sort of bouncing along the bottom. There's maybe some movement upwards, but the next, I think buying right now is a fantastic opportunity.
Well, I'll jump in here. One of the reasons I think buying right now is a fantastic opportunity is we may have talked about this slightly earlier, is that we've had the most deliverables, in the last few years. But I mean, currently the starts are abysmal. I mean, here in Portland, Oregon, like they have offered 5,000 units, like no SDC fees to try and get developers to start, and they're still struggling to get through that. And my understanding is that's kind of proliferated throughout the US, and Portland's significantly harder to get a start, and I think kind of like California is harder to get a start, whereas maybe some of the Sunbelt states are not quite as hard. But my understanding is there's just not a lot of planned new units.
Look, real estate is local for a reason, and understanding the pipeline in a local town was key, right? And I think a lot of people maybe overlooked that in the hysteria of that run up to sort of 2022. And I think a lot of people today are really looking at it, right? And not just what do the next 3 years look like, but what do the next 5 years look like? And you can't, with development, you can have deals sitting on the shelf for a period of time, and you can't really always accurately predict when the next wave is coming. Right. But, look, the cost of construction is still going up. You guys are in a high barrier to entry market, which makes existing assets probably more valuable, and a lesson that people can learn when you say, oh, I'm just going to go invest in red states. And you're like, well, look, there's good things about investing in red states, but there's also good things about investing in blue states and having high barriers to entry, which means, it inherently makes the existing value of assets higher, right? Because you can't just come along and slap up anything, like in Houston, where there's just, acres of land and you can just put up anything wherever you want. So there is and I did development in Los Angeles for many, many years and in New York. So I sort of understand that value that can be created by buying existing because it's cheaper than the replacement cost in, say, a Portland or an LA. So, and I know groups who are barbelled, right? They've got some stuff in red states and some stuff in blue states. I was speaking with Tryon Properties yesterday, a group out of Los Angeles. And they're actively buying in the Bay Area, right? They're because of the thesis of that things are coming back, and so I know they own in Portland as well. So, and they're also in red states. So,
and in Miami,
right in Miami. So what I'm trying to get is that wherever people are just only invest in red states. Well, you're sort of throwing the baby out with the bathwater. And you got to understand what makes real estate is local. And back to your point about the development coming to your pipeline, you have to really look at that as it's, as you're buying new deals. So, yeah.
Certainly the deliveries are one element. Like looking back at the precursors to the, huge price drop from, 2021 and 2022, I've looked back a little bit at it, and also, a run-up of massive development, and as well in combination with interest rates dropping. That, like, for the last 2 cycles has proven to be a, absolute, thrust in pricing. Like, so 04, 05, 06, that was also a massive run-up of development. And interest rates dropped. Like, they went from 6 to 4% over that period of time, and everything went crazy. And then, what also lending, all the unscrupulous lending practices leading up to the Great Recession caused, the huge bubble in the housing market there. So at least this time around, there was no huge bubble, which was nice.
Well, not huge bubble in certain, like, it feels recessionary in the multifamily space right now. It probably feels recessionary in the office space right now if you're a large owner of office space. So, particularly secondary and tertiary markets where COVID has now forced us all to work differently. I completely agree. And I think that's lessons learned, right? Like talking to someone the other day, like interest rates dropped to nearly zero. Where are they going to go? They're like, you're at historically low interest rates. Like, of course, things are going to be out of whack. It's not, they're going to stay there. And so I think coming back to some normalcy where we're sort of floating around that high threes, low fours is probably where we're going to stay for a little bit of time. I don't think we're going back down to those days. Maybe we get there in 5, 6, 7 years time. But if you do, you know what you're going to do? Sell your bloody asses, because it's going to be a frothy market, and we've already been through a cycle. So, like you got to take lessons learnt from times when you skin your knees, and we're going. From all of us, we're probably going through our first real major downturn, and we're all surviving, and we'll get through to the next one.
So, I guess I'm interested in how are you trying to get deals done with the credit being so tight? Like it's so difficult to get a loan, and on top of that, the terms are significantly worse than they were 5 years ago.
Well, good thing on the deals that we've been doing is that Freddie and Fannie are still lending. And we have done probably 7 deals in the last sort of 2 years, 2.5 years. And we've kind of straddled the pros and the cons of both institutional world and the retail world. And so case in point, we just closed on a deal in Fayetteville, North Carolina, but we've still got about $3 million left to raise. But because we're partnered up with a programmatic institutional partner, Monday Properties out in New York City, we're able to bridge that gap between us, and then we can backfill with retail equity. So we also did another deal in Fayetteville where we had a huge institutional partner come in, float the entire equity, and we just backfilled 50% of their money over a period of 6 months. So we've again, not one side of the fence is the best for raising capital right now. There's a lot of institutional groups that are on the sidelines. They look at that treasury and say, I'm not going to, really get it back in the pool until it gets closer to 4. And then on the retail side, you've got a lot of guys getting hurt and with deals being handed back to the bank. So trying to straddle the two of them, but the commonality is that it takes longer to raise money these days, and we've had to try and figure out a way to do it. And part of that is, with RSN, we were trying to push higher into the institutional world, doing $30, $40, $50 million deals. That realization is maybe that we can't do that for the next 12 to 18 months, right? We just got to go back to our sort of sub $25 million deals, do 3 or 4 of them a year. We can raise, our own money internally. There's still debt there. And so there are things changing in real time. But back to sort of how we're getting it done, it's like we found a partner that we really love to work with. They're also interested in sort of the retail side of the spectrum. We've got investor relations guys and funnels build out and all that good stuff online to drive traffic and raise money. But it's still the sort of the cycle to get an investor in and educate them about us, get them to invest in a deal is taking a lot longer. And each deal that we've done in the last sort of 2 years, there's been some element of post-closing raise, and that just goes back to the to sort of the environment we're in. But on the lending side, I haven't seen because we've only done agency debt. We've done one bridge debt on a distressed deal in Dallas. But yeah, it is tough to raise equity right now, particularly when the average investor's stock portfolio has probably gone up 20% in the last 3 years. So,
yeah, 20% per year.
Yeah, right.
Yeah, I mean, you kind of nailed it. So I guess, what about finding deals?
Yeah, so finding deals, I think this sort of sentiment of like, the extend and pretend, right? So you got to understand a little bit around the context of where we are from a lending perspective. So prices have dropped, rents have, interest rates go up, prices drop, rents have declined, right? Expense is also go up. So margins are thinner. Banks know.
Huge NOI compression there, right?
Huge NOI compression, huge NOI. And banks know and have learnt from 08, 09 and was mandated from both current administration and former administration to not whack lenders, right? Work with them. And so there's been extend and pretend. And it's been going on for a period of time now. that has caused two things. One, it's good for not a run of the markets. We get that, positive. But the second thing is that it's probably extending some of the pain that probably needs to happen, right? To sort of have that real hard reset. And then you couple in all the other things that are going on in the world today. So, there is this element of, I think there's going to be a lot of distress, and this distress is coming, and it is there. But it's not that every deal that you pick up that is quote unquote distress is a deal, right? Because there's a lot of deals we look at that are even lower than the bank balance. And so banks are either saying we're going to get rid of it, or we're going to try and hold on to it and work it out ourselves. And that's, I don't know when that, if it all comes at once or is just still a bit of a slow trickle. We look at deals all the time where you got to really look at, is it a distressed deal or is it a stress operator? And you don't want to be picking up both, right? You want to really be picking up the distress operators where we picked up a deal in Atlanta where the person had some other deals not going so great. And so he just didn't have a lot of time to focus on the current deal, but the current deal was completely fine. We put new debt on it. It's been a really good little deal for us. So it just really depends on, you got to look at more deals, but there's not as many deals out there to look at. So it's sort of it's a chicken and the egg scenario. And, it goes back to, this sort of expectation that every single deal is going to be distressed and every single deal is the bank's going to want to, write down and cut down their note in half. It's just that doesn't seem to be playing out as much as what maybe the wider market expected.
And I mean, correct me if I'm wrong, but I feel like we've seen kind of like some attrition of operators in the market. And there's I don't know for sure, but my assumption is that there's probably a good amount of operators that like have to be doing deals in order to kind of stay in business. Mm-hmm. Is that kind of your same kind of like outlook on some of the stuff?
Yeah, look, 100%. Like, you can't be throwing stones at glass houses, right? Like, when times are good, when you're buying deals, you're selling deals, it papers over the cracks that we are in a business that is fundamentally based on transaction volume. And if you don't have transaction volume, the beast can slow down, right? Particularly if you have a pref that you sit behind as a GP and you really just you're living off asset management fees, which doesn't really pay anything. So, and then your hope is that you buy deals, you plant the seed in the ground, they come to harvest, you sell them, but nothing's been selling in the last 2 or 3 years. So there is a realization, I think, in the syndication world of the flawed business model in which you exist around, and thus why people are going out and maybe having bolt-on or supplemental things in terms of debt funds to create passive reoccurring, revenue to keep the lights on when deal volume is down. So, it's not a quote unquote like taboo subject. It's just more of a realization, particularly coming out of such a frothy period, leading up to 2022, in my opinion.
When I think what you said is like, when times are good.
Right.
And the asset management fees are not enough to really like kind of keep the lights on essentially. But I mean, like, would you see like this period in time as like identifying that like this particular business is, potentially flawed and like maybe needs to change too? Or is that?
Sure. Yeah, no, I'll completely say it out loud. Yeah. Like, I run a syndication business and, I've got, and this might sound bad, but like, people who come up to me and say, "Oh, I want to start a syndication business." Like, great. Well, you're going to have to get to $300 million AUM before you can have enough recurring revenue just with asset management fees to support a team of 5 or 6. I run one right now. I know what it costs, right? Now,
right.
You can have construction management fees on top of that. And that's where people go and do and absorb the property management, so they can generate fees that way to keep the deals going. But when deals aren't selling and you are sitting behind a pref to your investors, that's where I talk to a lot of people, and maybe, at one of our masterminds that we were at, like some of the groups we know don't actually have a pref. And that can be counterintuitive to an investor to think, well, the GP's eating at the same time. Well, when you're sitting behind a pref, you're probably more incentivized to sell it a lot sooner rather than just sort of sit on it, because you're also, for every dollar that comes in the door, you're sharing maybe 80-20 or 90-10 split. And that's a more sustainable model. So maybe you see a future where the pref goes away, but when investors are addicted to the pref, it's sort of put yourself in a rock and a hard place. So, but I do know investors who have never had pref. And I said, if I did my time over again, I'd probably never have a pref. Might be slapped on the wrist by saying that, but it is you have to understand when you go through a slow cycle like we're going through, what, to make sure that, everyone's eating at the table at the same time.
So I guess back to buying deals, like the preferred return or no preferred return question, I feel like that is a classic syndication question. But to pivot just slightly, so we're talking about buying deals. So I guess one of the things that I'm finding difficult is trying to underwrite rents and rent growth, and essentially, the difficulty in placing a value on an asset when rents haven't been growing. They've actually been going down.
Yep.
And then as well, the future is very uncertain about rent growth.
Correct. So my opinion on that is doubling down in your markets that you're already in where you have existing data. Now, for the new folks coming in, that's a little bit more difficult. But for seasoned operators, like I know we look at data all the time in our markets, and we can sort of test where levels are at on a studio or one bedroom, and we just kind of know. And I can tell you on Class C plus B minus assets, we are at probably 2019 pricing in terms of rents, right? I don't know if same thing where you guys are at, but we're seeing sort of a studio go for anywhere between, on the low end, $850, on the high end, $1,100 across the 7 different MSAs. One bedrooms are between $1,000 on the low end and $1,250 on the high end, or maybe $1,300. And 2 bedrooms are somewhere between $1,250 and $1,500, and then 3s are sort of above that. That's the range, right? And I think you've got to understand affordability, right? And what people can afford to pay. And, expecting that you're going to get, I don't know, $300 pop on a studio in Phoenix on a Class C plus is a little bit, you can't be underwriting to that because it's just not true anymore. And when you've been in the market for so long, you can understand what the measure is of the appetite of that renter. And I know we're looking at deals in Phoenix right now that have come back to us, and we look back at old underwriting where we underwrote it for like 2 or 3 years ago, and the rents are just not there, right? And so you have to then go back to what I was saying earlier about that positive leverage. So if we got that positive leverage day one, well, if I do nothing to the rents, and even if they go down a little bit, I've got a cushion there. Because I do believe, back to your point on the construction, that there will be a time where rents do start to move in the positive direction. And that's why buying today, how do you underwrite to that? Well, you can't underwrite to aggressive rent pops, probably doing a 0 to 1% rent growth at max in the next 12 months, maybe growing to 2% the year after that, maybe stabilizing at 3% rent growth thereafter. Having a lot of understanding of your concessions in the market, really understanding a rent roll and seeing where the last 30, 60, 90 days are in terms of your lease trade outs. Is that lease trade out growing, or is it contracting, meaning that new leases are less than the existing leases? Understanding all of that goes into how to underwrite deals. But then there's also the thing of looking at just pure bases, right? Like I'm seeing some deals where it's very attractive bases, like, not you chuck the rent roll out, but like I can buy something at $140K a door where the same thing traded at $230K a door in the peak. You're like, I'll buy that all day long, knowing that it's just a good buy over the next 5 years. It's not a fundamentals of an underwriting thing. It's just more of the time in the market and underwriting so many deals that when you can see a good basis deal, you're like, I can pick that up. Like, I bet you I came to Portland, I'd be like, I don't know what a good basis deal is, but if someone presented you, I don't know, what I don't know what would be a good base. What would be a good basis in Portland if someone said, don't even worry about the rents. Like if you got this deal at X, what would that be?
It just depends on the asset. I mean, we
call it a Class C
deal at $100K a door, last year.
Okay.
That was a phenomenal basis.
We've got all 2 bedrooms at $140K a door.
That's good.
Like, and it's in like the heart of Portland and inner Southeast. Like that's
beautiful. Yeah.
I mean, especially when our median house price is like $550K. So
right. So again, there does come a time where your numbers won't lie, but there's also, doing, I think for the folks who are newer on listening to this podcast, is like you have to kind of do the reps and a lot of them in a market to really understand and look at historical data to really understand what you're buying today. And regardless of the rents from a basis play.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more.
Hey, let me ask you, what if tax season was actually exciting? I know, it sounds crazy, but not when you've got the right playbook. At mymoneyworksforme.com, we put together the Pro Tax Strategies playbook that real estate professionals use that you may not know about. You'll learn how to crush taxes with depreciation and rep status, how to stack smart write-offs from the Augusta rule to vehicles, and the ultimate wealth hack, 1031 exchanges and vacation rentals. It's free, it's powerful, and it's waiting for you at mymoneyworksforme.com, because your money should work as hard as you do.
One of the, I mean, this is kind of like a really newer real estate rule, but we look at the 1% rule. Do you guys take that into account? I mean,
no, not really. Not on when we're buying 100, 200, 300 unit properties. No, we don't look at the 1% rule as much as maybe you may do that in a smaller property. And not saying that that's not, but there's too many moving pieces. On a larger property, but a 1% rule totally works on a smaller property if that's if you can make it work. So is that still working for you guys in Portland?
Arms around it,
right?
Yeah. I mean, I really like that rule, and I mean, we used to never be able to find it in Portland, and so now it exists, and so that's kind of like a combination of the basis play, and it's like, okay, well, even with rents going down, the basis has dropped so much. Like at some point, we're going to get back to the peak values. Maybe not next year, maybe not in the next 5 years, but eventually we will get back to it, and it will be a good deal.
And I think the big thing that people it's resetting expectations of. We had a bit of frothiness. And we are guilty of it, where we're sort of flipping these big deals in 3 years' time. Like historically, real estate is a medium to long-term investment and should be treated as such, right? So putting medium to long-term debt on it, putting 3-year debt on it, stupid. Look what happened, right? So changing a mindset that maybe I'm going to hold this thing for 10 years. Maybe this is a fine investment for 10 years, and getting away from this sort of like, I need to show a 5-year pro forma, and if I can get out in 3 years, fantastic. I think that's changed a lot as well in terms of the, educating the investor on what to expect when you come into a real estate deal.
And it certainly makes it harder to raise capital.
It does. It 100% does. But I think that's where it goes back to our job as sponsors to show the data, show the historical trends, and say this is why we think this is a better play today, and then really sell it on a longer term hold.
And we've done some heavier value adds where we put some bridge debt on, and then then a 5-year loan on top, so like total of like 6-7 years, and explain that to investors. But we still model everything on just like that 5-year, just because it seems like the investor market is
Yes.
just so used to seeing and
Yes.
looking at like, what is it in 5 years? And
Mm-hmm.
it's like trying to get it to compare apples to apples. And then, as we
Mm-hmm.
start talking more about the specifics of the deal, it's like, okay, so you got to understand, like, there's probably going to be an extra 18 months, 2 years, like, in this. And, it sometimes drives people away too. It's like, well,
It
so you're
does.
saying there's not an opportunity to sell it in 3 years? I'm like, well,
Well, I've got a deal with a former business partner where we stupidly, the second deal I ever did back in 2020, it must be in 2025 or 2026. We put 10-year debt on a 5-year business plan. That was dumb, but we got to ride out, the waves, and it ends up being fine, but like, it's just looking back at times and going, just sort of shaking your head and thinking, what was I doing?
well, I mean, I think if we all had a crystal ball, I mean, we'd put the exact amount right,
We'd all have
right
10-year
time on
debts or
everything.
10-year loans.
we might not be doing this podcast,
So, Rita, I've got another question. So, like, are you seeing anywhere or any market, or do you have any, I guess, hunches on where you think is going to recover first in terms of just like migration and in terms of affordability and possibly where you're seeing capital deployed if it's being deployed?
Yeah, look, there's affordability is still a big thing. You depends on what state you're in. Like, ask a Texan, ask a Floridian, ask someone from North Carolina. They're all going to say our state's the number one, and there's 150 people moving here a day, and blah 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 blah. Like, it's just the same. Like, and it goes back to the real estate is local, so really getting understanding what that construction pipeline looks like in sort of a 2, 3, 5 mile radius of an asset. Understanding the macro growth is pretty easy data you can get to. And then if you can get at a really true positive leverage day one, because there are things trading at true 6 caps, 7 caps in secondary markets that may not trade there in the future. So, one particular market, no, I don't have one particular market that I'm like hot and heavy on. I'm still across all my fundamental markets that I've always transacted in. It's just that I look at these things. I've got so much data to look at to make a better investment decision today than I did maybe 5 years ago, but based on just being in the market for that period of time. So, again, I think sticking to the fundamentals of underwriting, sticking to the fact that, rents will go up and have always historically gone up, in lockstep with inflation, and looking at the construction pipeline of what's coming down in terms of new starts. And, again, thinking about it more from a medium to long-term perspective. If the deal ticks all those boxes and you can protect yourself against the downside, like fixing interest rates or underwriting to today's rents, if anything goes above and beyond that, you're going to do just fine.
And so when you say like you want to understand the construction pipeline, like, in terms of the construction pipeline, some, development and construction that can attract population growth and, infrastructure upgrades. Like, so, I mean, honestly, since there's, we've gone through this dearth of new starts and development, like a place, a metro getting more development than say another metro might mean that it may recover sooner.
Sure. But look, take the Bay Area, for example, as like it sort of was the doom and gloom of COVID, and it's now rebounding. Look at New York City, same sort of thing. So if you're going to stick to say the Dallases of the world or the Austins, like Austin's a great example of like oversupply. Infrastructure has not kept up. I am heavily invested in Austin. I still believe in it fundamentally from a long-term perspective, but it's had some growing challenges, right? You compare it to say something like Phoenix, where there's probably the two darling children of the pandemic era and growth and all the headline of all the stats and blah, blah, blah. But Phoenix was able to absorb its construction a little better because of the infrastructure it already had. Right, Austin has had a bit of a growing pain problem, right, with its infrastructure, and so back to your point of like, kind of no one can say, oh, I looked at that and that's what I made my decision on. But you've got to understand those things at the growing pains of these cities, and how they're going to keep up with that construction, to your point. So I'm not sure if that answers your question, but it's like something that I've observed, invested in both of those cities, right? Take Dallas, for example, another major metro that it's taken us a long time to break into that market because it was such a knife fight for so long. It wasn't till this sort of reset that we got our first asset in Dallas. So, that's got our foot in the market. Now we understand more the fundamentals of that market. More opportunities are going to come our way. So, yeah, in general, it's more about sticking around the hoop, getting the rebound, but also understanding, maybe going a little bit deeper in terms of that construction. And what does that mean if more people move to that city? Can that city handle it? Like I had a former employee who used to live in Austin, and I'm not saying this is the norm, right? Like, but he was just complaining about trying to get to see a doctor, right? Again, basic infrastructure stuff, because there's just so many people moving to the city, and so there's going to be a choke point, and that has both positive as negatives, and I've got deals in Austin right now that are just, they haven't got through their supply yet. But when they do, it's going to continue to be a fantastic city because it's going to continue to grow. So, investing in the fundamentals and investing in growth, I think, is always going to be a good, sound investment advice, over the long term.
Okay, and then, so what initially attracted you to Austin, and then I guess when you're looking at a market? I mean, you've already touched on a few things, but I would just be interested to hear your perspective.
Historically, like, I started in San Antonio. Now, I wouldn't touch San Antonio with a 10-foot pole, right? Like, so because of the supply and existing supply that's in San Antonio, and just because I've been in that market for so long, like, I went to San Antonio because of the cap rate versus where I used to live where I live in Los Angeles. Right? It was just cheaper. But there is now, knowing what I know, there's just a lot of existing deals there, and the renter mindset in that market is sort of like stuck at a certain. You can't like break certain barriers when you go from 1 bedrooms to 2 bedrooms. It's very difficult. And then then we moved up the I-35 into Austin because Austin had that more of a bohemian feel, and it had a bit more of a coastal feel in the terms of there was a barrier to entry for new construction, right? And you could see sort of a moat being built for that new construction, even though it's a red state, and that was sort of an investment thesis that we believed in. Lo and behold, a lot of suppliers hit that market, and it's choked a little bit. Doesn't mean it's not going to absorb it eventually, but by and large, the reasons we went into into other markets was more for that affordability. We just bought a deal in Fayetteville, North Carolina, as I mentioned before. It's the biggest US military base in the country. It's only about 500,000 people. It's going to have a different exit cap rate versus a Phoenix, which has 4 million people, right? So you've really got to understand, when I go and buy a deal in Fayetteville, I need to be seeing things north of a 6 cap, and I need to be exiting at north of a 6 cap, because it's not just that market's not just going to go from 300,000 people to 1 million people in 5 years. It's going to slowly increase. But if I'm buying in, say, Phoenix, I might have to, look at a 5 cap and, maybe expand it to a 5.5 cap, because that's just what, it's going to continue to grow. It's going to continue to attract institutional capital. So it really does depend on the market and what you deem is good value, moving forward.
You said you wouldn't touch San Antonio with like a 10-foot pole, and is it just because the typical renter there, you can't really push the limit on it, or is there more kind of like around the marketability of the city that is
no? Yeah, I think a couple of things. And again, I'm not saying I'm an expert in San Antonio. Love the market. I've sold
10 years from now, it might be completely different, right?
Correct, but it's there's a couple of things in San Antonio, and it is the 4th sibling in the line. You know what I mean? Like it's the 4th sibling. It's not part of the top 3, right? It's not Houston, it's not Dallas, it's not Austin, and it knows its place in that line, right? So you look at there are people investing in San Antonio. And really what I mean by investing in San Antonio is San Antonio's investing in itself, right? It's not a sexy city, by any stretch of the means. But there's also a lot of existing assets there, meaning that, you drive down Fredericksburg, I think it's Frederick Avenue, Frederick Lane. There is just wall to wall 70s, 80s vintage stuff. There's just a lot of stuff there. And so when you're going in and buying existing assets, you really got to be careful about where you buy. They talk about, at least in my opinion, the Martini glass, right? Where you're downtown San Antonio at the peak or the bottom of the Martini glass, and then you sort of got the I-35 up one way and you've got whatever that Western Highway. You want to be sort of in that northern area. But you've got to be really careful about what you do get into down there, because there's a lot of rough stuff like there is in every market. And then there's going to be add on top of the sort of the why people move to San Antonio is because it is a lot more affordable than most of the other major metros in Texas. So there's naturally, like when I first started buying down there 10 years ago, $1,000 rent check was sort of like mentally the limit of like a class C plus, B minus, 80s vintage asset for a 2-bedroom. And that's obviously increased. But there's just still that natural balk at things that people will pay for. And so when you start adding in trash valets and cable contracts and all this sort of stuff, renters just say, no, I'm not going to do it. So they're very price sensitive in a market like that for sort of workforce housing. So being aware of that is really important. You couple that with, say, another market we're in Greenville, South Carolina. I love that market. Reminds me, Greenville, Spartanburg, reminds me a little bit of San Antonio, Austin on just a smaller scale. Again, we've got workforce housing in that market as well. We've got a tax abatements deal where we keep our AMI rents below a certain AMI. Yes, renters are still price conscious, but it's not as price conscious as say San Antonio. Same with Austin, right? Again, you start to identify these trends where people can afford to pay for certain things where other markets they won't. Another great example is like people will pay in Phoenix for in-unit washer dryers. Like I have seen people cut the bathroom vanity in half and shove a stackable washer dryer that looks the most disgusting looking thing next to a tiny little shower, and people will pay for it because they just don't want to walk out in the heat. Where in San Antonio, making sure you've plumbed your fridge to have an ice maker in the freezer is key, because people love their ice in their Yeti cups in San Antonio. So like these little things that you pick up as being a sponsor, but on the other side, like it took a long time. Like we were very I was early on, but like we used to start providing back in the day, their washer dryers didn't come with the units, and now it's sort of become very commonplace. But back in the day, it was very much like, no, I don't want to pay for a washer dryer. I've got my own one from my previous residence. So again, renter trends, renter expectations, and the sort of different things that certain people will pay for, you need to be aware of when you're going to certain markets.
Yeah, we're definitely seeing that trend in Portland too, where we would have units with just hookups, and there's virtually like the type of renter that would bring their own washer and dryer is diminishing for sure.
Right. That's right.
That's right. And we do find that having a washer dryer in unit is certainly a huge perk in the unit.
But it took 10 years to get to that point, right? So
or even more.
Yeah.
I mean, the summer here, this particular summer in Portland is seeming to be warmer than like maybe typical, and we're getting a lot of questions about AC, and we're not required to have AC in this market now. So very little
at the moment.
Yeah, I know. But there's like virtually no units have AC unless it's like a premier
Interesting.
Unit. Yeah.
Interesting. Gotcha. Yeah. So like that's you go to Phoenix and there's boiler chillers up the wazoo, right? And you've got to keep. We've been slapped over the wrist sometimes where city inspectors come along and the chiller isn't chilling air, but you can prove to the unit because it travels through the duct and it loses its coolness, and by the time it gets to the unit, it's 78 degrees blowing hot air at you. But at at the chiller, it's it's at the right temperature. So it's interesting. That's again back to I wouldn't have known that entering the Portland market, and again, things you learn by just being an operator for a period of time.
And so you said you recently got into Dallas. Like, was it the job growth or just that other people were in there? Like, what drew you to getting into that as one of the top three? I mean, it's super adjacent to Austin. It's like, what, 3 hours away, 2.5 hours away or something?
Yeah, Dallas has been probably one of the biggest growth cities in the country in probably the last 15, 20 years. And so being part of that was always exciting. And, if you're going to be in Central Texas and, do you want to go and pay $100K a door in Dallas or $120K a door in Dallas for existing 80s vintage product? Or do you want to go pay $100K a door in San Antonio? And it was just like, I'd rather go pay it in Dallas, right? I'm betting on Dallas than I am on the San Antonio growth. So, it is a bet on growth. It is a bet on the people continuing to move there. And that's what we're going to have an upswing in the next sort of 5 to 10 years. And again, this is not a poo-pooing on San Antonio. This is just, you asked me why. And it just, you sort of, you go to trying to skate to where the puck is, consistently going to be. And that's what our thesis is, that it's going to be Dallas.
You got to hang around the rim, and then you got to skate to where the puck is going to be.
Yes, that's right.
And,
that's right.
What other sports analogies can we throw in there?
Down the fairway, that's another one. Chipping onto the green. I don't know. I don't even play golf, so it's so yeah.
Maybe kind of a follow-up question to this. Like, did you go spend time in Dallas yourself to like really learn the market, or are you relying on partners? Or, I mean, no. I've spent like a couple days in Dallas, but I mean, certainly not enough that I would be like, oh, like this. I mean, I've heard a lot from economists, and I see the trends in migration reports, and a lot of the data along with it. But I guess I'm just kind of curious your experience. Or
look, I think one thing I've found in general is that this is a blanket statement, but like when you're shopping in these markets for workforce housing, you know what you're touring. Like, I've toured hundreds of properties across multiple different markets over the last sort of 10 to 12 years. And the basic sort of stuff. Okay, what's your average household income within a mile? Okay, like, check the box. Is it above or below your threshold? When you go to that market, you're going to see the same box retailers that are going to be in those types of suburbs, right? And you're going to see the same things. And it doesn't differ too much between Phoenix or a San Antonio or an Austin. And so using that global data that's available helps you to do a desktop underwrite, and then you go tour deals, and then you start to put the pieces together and see where the people are going. But there's a lot of I've been sort of saying things in code here, like if you underwrite 100 deals in a market, you may never have stepped foot on that market, but you're going to have a goddamn better understanding of that market by literally just underwriting 100 deals. Yeah. And that's how I started doing it in San Antonio from LA. That's how I started doing it and started moving across the country. When we first entered into Greenville, South Carolina, like I was underwriting deals for a good 12 to 18 months before I got my first deal under contract, right? It's the repetitions. And yeah, going to site is really good and getting boots on the ground. 100%, I completely agree with that. But you can get like 90% of the way by just doing sheer volume. Like if I was to enter the Portland market, my number one first thing I'd get my analysts to do would literally underwrite everything that hits the market in Portland for the next 6 months or next 3 months. And they really start to build a library of knowledge about that thing. Start going there, meeting with brokers, shaking hands, kissing babies, touring deals, and you can start to see the trends. And over time, you can sort of make a good investment thesis based on just a sheer volume of underwriting deals.
Yeah, I like that advice. We started underwriting Jacksonville and have just kept track of like everything that comes on the market. We shook hands with a bunch of the brokers and have gotten the deals coming in, but I mean, nothing's penciled yet, but you're giving us hope that something in the near future might. So But I think we're getting towards the end here, so let's hop on to our last 4 questions, and I will start us off. Is what's one piece of advice you would give your 25-year-old self?
It's a marathon, not a sprint, and I've always been that type of guy to think that it's always a sprint, right? But yeah, it's a marathon, not a sprint. So take your time.
I like that.
Make investment decisions for the long run, right?
Right. That's right. That's right. That's right.
Or work on the process and don't worry about the results.
Yeah.
All right. Next question is, what was your first entrepreneurial endeavor?
I remember selling, just bags of dirt and lollies and stuff on the side of the road when I was a young kid trying to, get some dollars for. I remember my mum handing out 50-cent coins to the neighbors to make me feel good that there was someone who was buying something from my crappy little stand.
That's awesome. So they don't sell lemonade in Australia, huh?
No, I didn't. It was like looking back, like there's a very clear picture of me selling sandwich bags full of crappy dirt for some reason why I think people would want. Why was I doing that?
There's gold in there.
Yes, there is lemonade in Australia. Yes.
Sign of a good salesman.
It's a lot of rocks from that topsoil. So.
All right, next question. How has your formal and informal training shaped your journey?
Formal civil engineer by trade, problem solving, mathematical brain, always have been, systems process orientated. Informal, do it. Like I didn't get an MBA. Like I remember doing my first deal, 192 units as a lead sponsor, and I was like, that's essentially an MBA. Like trying to raise money, put the deal under contract, get it financing, all that stuff. Like. So, they're just going out into the world and doing it. Informal training is so valuable.
Yeah. Okay. Our final question. What was your biggest mistake and what did you learn?
Oh, mate, there's been so many. One that's come up more recently, short-term debt. We've spoken about it nausea. I am guilty of having a few of those, but probably looking at a rent roll in 2022 when stimulus money was in circulation and thinking that was the new norm. That was probably a very big mistake looking back at that. Now, did I know at the time? No. Did any of us know at the time? Probably not. But needing to understand that giveth with one hand, taketh with the other, it will dry up. And that was, I still remember to this day sitting on an asset management call and rents dropping $300 overnight. I was like, what the F has actually gone on? And then you dig deeper and it was like, yes, stimulus money turned off. And you're like, oh, wow, that's going to completely ruin my rent roll, So, and then making a 5-year investment decision on that was a massive mistake.
Well, Reed, it's been a pleasure chatting with you, and thanks for coming on the show and sharing your experience and your knowledge.
Pleasure.
If our guests want to get a hold of you or learn more about you, what's a good method or mode for them to get in contact?
Easiest way, hit me up at reed@rsnpropertygroup.com. Or if you're ever coming through Los Angeles and you want to meet up for a coffee or a beer and shoot the breeze, let me know as well.
Awesome.
All right.
Very much appreciate it.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on Win, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.